There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
Value investing is a time-tested investment strategy that involves identifying undervalued stocks and buying them at a discount to their intrinsic value. It was popularized by the legendary investor Benjamin Graham and his most famous student, Warren Buffett, who went on to become one of the wealthiest people in the world using this strategy. In this video, we'll take you through the 5 levels of difficulty of value investing, starting with the basics and gradually moving up to more advanced concepts. Whether you're a beginner or an experienced investor, this video will provide you with a comprehensive understanding of value investing and how you can use it to make informed investment decisions. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. Beginner. Why waste 20 precious minutes of your life learning about value investing? Well, because it's the one investment philosophy that has made people filthy rich for almost a century. We're talking big names like Benjamin Graham, Walter Schloss, Charlie Munger, William Ruane, Joel Greenblatt, and the one and only Warren Buffett. Now let's talk about value investing. It's a pretty simple concept, really. You just need to find something you can buy for cheap and then sell it for a profit. It's like being a bargain hunter extraordinaire, but instead of shopping for clothes or shoes, you're shopping for assets that can generate cash in the future. I mean, who needs designer shoes when you can have a portfolio full of undervalued stocks, am I right? And don't worry, you don't have to be a pirate to practice value investing. You're not stealing from anyone, you're just being savvy with your money. When the rest of the world is willing to pay $1 for something, you're trying to get it for 50 cents. It's like you're playing a game of Monopoly, but instead of trying to bankrupt your friends, you're trying to make a killing in the stock market. But don't forget, buying is only half the battle. You also need to know when to sell. You can't just hold on to an asset forever. You need to know when to let go. It's like a bad relationship. You need to know when to cut your losses and move on. When the market catches up to the actual value of your asset, it's time to cash in and enjoy your well-earned profits. Novice. These statements are too vague to act on. You may be wondering, okay, but when is an asset a bargain and where do I find one? Let's start with what creates a bargain. Cash. Value investors track cash flows like a hawk. Real estate investors look at rental income minus expenses. Bond investors examine interest payments and repayment of principal. And stock investors, although I'm simplifying a bit, look at earnings per share. In theory, any investment is worth the net amount of cash it pays out to its owners from now until the end of its life. Let's look at 2 value investors, Sarah and Jack. They're both obsessed with cash flows like all value investors. Sarah has invested $1,000 in a bond that pays her $60 per year in interest. Her return is 6% per year, $60 out of $1,000. Jack has purchased shares in a public company, XYZ Corp. They currently earn $4 per share and they cost $80 each, so his return is also 5% per year, $4 out of $80. This is the EP ratio, which is better to use than the more commonly known PE ratio because it's easier to compare to investments outside the universe of stocks. For Sarah's bond, the payment of $60 per year is fixed, but that's not the case with XYZ Corp's earnings. If the earnings increase in the future, Jack's return will be higher than 5%. XYZ Corp has increased its earnings per share by 50% since 2010, so we have reason to believe that it will continue to grow in the future. At this point, we could expand our definition of value investing to buy assets with cheap cash flows and sell them when they are no longer cheap. As it seems like Jack purchased a superior stream of cash flows for the same amount of money, can we conclude that he's the better value investor? Well, not necessarily. Before we get to that, let's talk about Jane. Jane just purchased an NFT for $10,000. She hopes to resell it to someone else at a higher price down the line. Is Jane a value investor? Unlike Sarah's and Jack's investments, Jane's NFT has no cash flows. The father of value investing, Benjamin Graham, would say that the NFT has no intrinsic value. Essentially, intrinsic value is the value of an asset as if you could never sell it. The NFT throws off exactly $0 per year, and the only way Jane can make any money on it is by selling it to someone else. A value investor is never dependent on a resale price. Both Sarah and Jack are perfectly happy if no one ever wants to buy back their securities because they can just sit on them and collect the cash flows. That's the primary difference between a value investor and a speculator. Value investors adhere to the wisdom of Mark Twain, who said, "There are 2 times in a man's life when he should not speculate: when he can't afford it and when he can." Value investors can distinguish between an NFT and a company with solid cash flows. Average. Let me ask you this question. Would you prefer to have $1 million right now or wait 20 years to receive the same amount? The answer should be clear, not just because money is more valuable when you're younger, but also because you can use it to earn even more money. The timing of cash flow is just as important as the amount received. The sooner it is, the higher the value it acquires. This is what's called the discounted cash flow or DCF analysis, where we use a discount rate to adjust the value of future cash flows. If we use a lower discount rate, future money is worth more. But if we use a higher one, the value decreases rapidly. After accounting for the time value of money, we add up these adjusted cash flows to determine the value of an asset in the current times. The question is, how much less is future cash worth? It depends on your expected performance as an investor. One way is to use the historical average return of the stock market, which is around 7 to 10% per year. Value investors like Warren Buffett use a moving target based on the US 10-year rate, but they never settle for less than the historical average. The updated formula for value investing is to buy assets with cheap discounted cash flows and sell them when they are no longer cheap. However, the greatest value investors rarely use the DCF model to make investment decisions, even though some experts like your typical college professors may disagree. The reason behind this is that a DCF model can never be enough to know whether you have found a decent investment opportunity. According to Benjamin Graham himself, there's just not enough margin of safety. Great investors know that future cash flows are worth less than present ones and that the required return should vary with the economic climate. They don't need to calculate net present values with many decimal points. Instead, they rely on their intuition and knowledge to identify good investment opportunities with a large margin of safety. For example, let's go back to our investor Jack. Jack recently found a company called ABC Enterprises that has impressive historical growth and earnings yield. He doesn't need to use a DCF analysis to know that it has the potential to return more than 7 to 10% per year. But he does need one more thing. Experienced. The value investor's goal is to maximize returns while taking on an acceptable level of risk. If the return-to-risk ratio is significantly unbalanced, then the value investor may consider it a bargain. However, it is not possible to determine the precise level of risk associated with an asset as there are no nutritional facts available for it, just like what you see every day in food labels. Instead, here is how Warren Buffett defined risk. Warren Buffett believes that assessing the level of risk involved in a business is a crucial aspect of valuing it. When considering buying a business, he emphasized the need to consider the potential for permanent loss of capital and the possibility of insufficient returns on the investment, which are basically the two main factors that determine the level of risk for Buffett. In essence, the primary risk involves the potential for miscalculating the anticipated cash flows or overpaying for them. Now let's revisit Sarah and Jack's investment options, which include bonds, XYZ Corp, and ABC Enterprises. Specifically, Sarah's projected return is 6% annually, based on the assumption that she'll receive a $60 coupon each year for 10 years, followed by the return of her $1,000 investment at the end of the period. Now, is there any chance that the bonds will not produce the results she desires? I don't think so. But surely, there is a risk that the coupons will not hold significant amounts of value each year due to the never-ending inflation. With this in mind, we can consider Sarah's investments holding low scores on the risk-return scale. Enough with Sarah, what about Jack? How about his idea to invest in XYZ Corp and ABC Enterprises? Before investing in public companies, I like to consider several risks, including competition, management, regulation, suppliers, and customers. These factors have the ability to disrupt our projection for future cash flows. When it comes to competition, I pay attention to recent increases and potential new competitors that could emerge as strong players in the market. When evaluating companies for investment, I consider the industry dynamics, such as whether it's dominated by a few players or fragmented, as in the case of XYZ Corp and ABC Enterprises respectively. In addition, I also assess the stability and trustworthiness of the management team, as well as whether they have a significant investment in the company, as a sign of alignment with shareholders. In the case of XYZ Corp and ABC Enterprises, there have been recent changes in the management team, and insider ownership is relatively low for both companies. Another crucial factor to consider is the regulatory environment and whether the industry is likely to face any issues. While regulation is not a significant risk for XYZ Corp, it poses a considerable risk for ABC Enterprises due to societal concerns surrounding the iGaming industry. Additionally, it's highly important to assess input costs and supplier dependency, with XYZ Corp's approach of buying commodities and selling brands proving advantageous, while ABC Enterprises face greater risk due to its dependence on a single supplier for their materials. Another critical factor to evaluate is the customer base, such as the number of significant customers and their likelihood of continuing to purchase even during an economic downturn. Both XYZ Corp and ABC Enterprises operate in the B2C space, or the business-to-consumer space, selling products that are typically in demand regardless of economic cycles. Comparing XYZ Corp and ABC Enterprises, it's apparent that ABC Enterprises is the riskier investment option, and as such, Jack should demand a more significant margin of safety when investing in ABC Enterprises compared to XYZ Corp. As Seth Klarman aptly stated, a margin of safety is crucial in investing because valuations are inherently imprecise, the future is unpredictable, and investors are prone to errors. It's this adherence to the concept of a margin of safety that sets value investors apart from others who may not be as focused on mitigating potential losses. Taking everything into account, we can revise the definition of value investing as follows: acquiring assets with inexpensive discounted cash flows while ensuring a margin of safety, and divesting when the margin of safety is no longer present. However, like the DCF analysis, this is merely a guiding principle for the most successful investors and not a rigid formulaic approach. To illustrate, let's look at 3 examples of a margin of safety. Firstly, when a company is generating a return equal to or greater than your requirements and is also growing, as in the case of Jack's ABC Enterprises. Secondly, when a company is yielding more than your desired return. And thirdly, when a company's yield is around the required level, but it has a substantial net cash position, which Benjamin Graham was well known for favoring. Expert. Here is a scenario. In an unusual and charitable auction house located in the United States, attendees are prohibited from using mobile phones. The auctioneer announces the first item up for bidding: 5 $100 bills, which are genuine. Bidding begins and quickly escalates from $100 to $200 to $400 until finally someone bids $499 and the auctioneer declares the item sold to the highest bidder, a man wearing a blue suit. The next item up for bid is even more extraordinary: 100 notes of 1,000 Indian rupees. Despite a 25-second pause, bidding commences when a woman named Angeline stands up and offers $300. The auctioneer declares the item sold to the lady in the blue suit for $300. So let me explain what occurred and why this analogy matters for investors who prioritize value. When an investment opportunity appears to be an obvious value, it becomes difficult for investors to identify genuine bargains. This is due to the fact that prices are bid up too high by the market demand. Earning a profit of $5 is reasonable, but it's not impressive. Conversely, the deal that Angeline found to buy 100,000 Indian rupees was a true steal. Angeline was aware of this and deliberately understated her confidence in order to avoid attracting competition. Value investors typically focus on assets that are disregarded or unpopular. As contrarians, we seek out opinions that deviate from the mainstream. To illustrate, consider the case of Apple, which has almost 30 analysts offering the projections for its earnings per share in the upcoming quarter, as reported by Yahoo Finance. When there is such a high level of scrutiny on a company, it is improbable that you can obtain it at a significant discount from its intrinsic value. This begs the question: where should we look? Allow me to illustrate how 3 renowned value investors locate undervalued or neglected assets. Firstly, according to Seth Klarman, one approach is to examine lists of the top stock market losers over a period such as the past year. The rationale for focusing on losers instead of winners is that investing in the latter is too trendy, and thus they rarely represent true bargains. Secondly, a young Warren Buffett used to search for neglected securities that were listed in less popular venues like the Pink Sheets. While this list no longer exists, you can still emulate his strategy by screening for firms with market capitalizations below $90 million. In terms of investment approaches, I personally favor Joel Greenblatt's quantitative system called the Magic Formula. However, I find Peter Lynch's approach to be the most amusing. In his book, One Up on Wall Street, he looks for companies with uninteresting names and those operating in unpopular industries such as oil, gambling, weapons, funerals, and more. As the saying goes, the closer we are to danger, the further we are from harm. Therefore, as a value investor, the goal is to purchase undervalued assets with discounted cash flows and a margin of safety, and then sell them when that safety margin is no longer present. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!